I'm the president-elect of GPHSA. And so today we have the honor of Howard Johnson presenting to us about financial stuff that we all need to hear. Howard is a recipient of GPHSA's highest honor, a lifetime associate member. He served multiple terms as treasurer for our association and for many years organized our fun run. It was very popular at our annual conference. He has been generous in sharing his expertise in finance and investments with our association. He also has led the younger generation by being involved. Put this on my phone, I know it's a bad idea. But by being involved in various organizations where they could also learn about management and investing. Howard has also helped out with our periodic reviews and took us through that. We're very fortunate for the benefit of having this competent man who gives his service and dedication to us still, even after he's retired. I can also say that Howard is a very close friend of mine. We have known each other for many years. And I had to tell the funny story. The first time I met him, he said, "Don't ever say my name out loud in a room." And of course, every time that we would meet, my first thing would be Howard Johnson. So I know he still loves that. So without any other further wait, I want to present Howard Johnson to you. Thank you, Howard.
Okay. I'm kind of new to Zoom, so I just click share my screen.
Yeah, I've made you a co-host, Howard. Let's see if I may not have to. I may have to make you the full host. Is that? Why don't you hit share your screen and then put your document up there, and we'll see what we can see.
Oh, that's not the one I want. Okay, here we go. Let me put this in slide mode. Okay. Can you see that?
We sure can.
Stocks? Okay, all right. Well, Susan, thank you for that gracious introduction. And this tells you a little bit about what I'm doing. Now, I am a volunteer for this association, Better Investing, and I'm gonna downplay that part of it in order to get the information across to everybody, and then might talk during the presentation. There's some information about the organization, but don't want you to concentrate on that. Just concentrate on the information that you're going to be receiving. This is the organization is the 501c3 nonprofit. We've been in existence over 70 years, providing investing education and pioneers of the model investment club movement. And those are just pictures of some clubs that are part of the organization. This disclaimer, and really the only part that's important, is the first line. It's for educational purposes only and is not intended to be a recommendation to purchase or sell any stocks that might be mentioned. And I don't think there are any that mentioned, but we put this in just in case. I don't know how many have been in this situation. I don't know how many retirees we might have on the call, but this has happened to a lot of people in their careers. They get to the point where they're getting ready to retire, and they have to put aside their plans to retire because they're not financially ready. So part of this presentation is to make sure once you get to that point, you can pull the trigger and go ahead and retire and not have to worry about your financial situation. So we're going to talk about, we're going to define what a stock is and why we should invest in stocks and what to invest in and how to get started. A stock is a form of security that indicates the holder has a proportionate ownership in the issuing corporation. Corporations can sell stock to raise funds to finance the operation of their businesses. And if you purchase a share of stock in a company, that gives you a right of ownership. You own part of that company. You know, if you buy Home Depot, you can say, I own a part of Home Depot. If you buy IBM, you can say, I own part of IBM. So it just gives you a proportionate share of ownership. Two types of stock. You have common stock and preferred stock. With common stock, you have the right to vote on any matters that come up in the shareholders meeting, and you get a better return on your investment. Preferred stock, you have no right to vote, but in the case that the company liquidates, you get paid first. And if they declare any dividends, you get your dividends first. With the ordinary share, you get one vote for each share you own at the annual meeting of the corporation. And you get paid your dividends after the preferred shareholders. And in the case of liquidation, you get no preference. So this is just a summary of what I just said before. And with the preferred share, no voting rights, you get a liquidation preference, and you get paid dividends before the ordinary shareholders. Stocks are bought and sold predominantly on the stock exchanges. You have the New York Stock Exchange and NASDAQ, and these are the primary exchanges in the US, but there are other stock exchanges in the US. There are stock exchanges all over the world.
Hey, order for Bailey. It's 11:07. Can I trouble you? You can keep the change. Can I trouble you for some blue cheese and hot sauce?
We got somebody on a hot mic there. Historically, stocks have performed better than most other types of investments over the long run. You can't see this chart on this page, but it comes up in a slide later on that you can see much better. And we're going to talk about that when we get to that slide. Owning stocks gives you the right to attend the shareholders meeting, to vote in the shareholder meeting, or by proxy if you're not able to attend, receive dividends if and when they are distributed, and you can always sell your shares. Dividends are a big part of why you want to invest in the stock market. Being a shareholder is important. First, you're entitled to a portion of the company's profits. The more shares you own, the larger your portion of the profits. Many stocks do not pay dividends, but instead they reinvest their profits into growing the company. And that is the other part of why I invest in stocks, because of the price appreciation. You can make money in the stock market either by the price of the stock going up or by the dividends that the company pays you for allowing them to use your money. Or you can, if you're real lucky, you get both. You get price increase and you get dividend payment. So that's the best situation that you could be in as a stockholder. Companies can issue new shares to raise additional cash. If they issue new shares after you have already purchased, this dilutes your ownership and your percentage of the ownership goes down. You know, if the company has 100 shares outstanding and you own 10, you own 10% of the company. But if they turn around and issue another 100 shares, and now there are 200 shares out there, your 10% goes down to about 2%. Your 10 shares go down to about 2% of the company. So that's how your shares get diluted if they issue additional shares. And buyback usually benefit the shareholders, and that the company will go out and buy shares and take them out of the market, and therefore your percentage ownership will go up. Now, your percentage ownership with these larger companies is very small depending on how many shares you own, because most companies issue millions of shares of stock. And unless you're Warren Buffett and you can invest billions of dollars in these companies, your share percentage is going to be like in the 0.0 category, and it might be a few more zeros involved, but that doesn't matter. You still get the same dividend that anybody else would get, and when the price goes up, it goes up for your shares as well as they do for any that Warren Buffett might own. So in that way, it's all equal footing. Comparison between a stock and a bond. A bond is another investment instrument, but they are different. And with the stock, you have ownership. In the bond, you're loaning the company your money. In a stock, you benefit from the growth of the company. In a bond, your only benefit is the interest paid for the loan. Stock, the profits are paid out in the form of dividends, and with a bond, the interest payments made in the form of coupons is your, I guess, reward for loaning the company your money. I guess if we have any questions, you want to handle that at the end, Rhonda, or do you want to entertain questions as we go along?
Well, let's just handle that at the end. How about that?
Okay, that'll be fine.
Yeah.
Okay.
And they can certainly do the chat. Anyone can do the chat feature too, and we can ask questions that way, and we can read them out at the end.
Okay, good deal, good deal.
Yeah.
Okay, bonds are different from, let's see. Oh, let me go back. Bondholders are creditors to the corporation, as I said before. Creditors in the bankruptcy have a legal priority over other stakeholders and are made whole first. Bonds have a fixed duration. They're usually 20-year bonds, but if you have something like a municipal bond that a form of government, like a state bond or a city bond, they might vary to 30 years in duration, and they expire at a specific time, and the return on the bond is set by the fixed rate of interest established by the bond and paid over the life of the bond. Okay, this is that chart I mentioned earlier, and this is the historical return on assets for different classes. We'll start from the bottom. Down here, this gray line here, this is like the inflation rate, and the time period covered by this chart is 1926 to 2017. And this is for $1 invested. If you invested in treasury notes, that $1 over this whole period would turn into $22. If you invested in government bonds, that $1 would be $143. If you invested in large stock companies, that $1 would be $7,338. And if you invested in small company stocks, that $1 would be $36,931. So your best investment over the long term is in small stock companies, and small is measured by different categories, but in the association I work with, we measure the size by the revenue, annual revenue of the company. And if your revenue is under $1 billion a year, we call that a small company. And 1 billion to 10 billion in revenue a year is a medium-sized company. And if they have over $10 billion of revenue in a year, we call that a large company. And then some measuring sticks use the total market value of the company, and that's the value of all of the stocks outstanding in that company. And they do a similar breakdown, but it varies from your revenue stream. They measure by your market cap, what they call market cap. Now, this is the secret of investing, and it's not so secret, but it's the engine that drives investing. This is a quote from Albert Einstein. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And that is so true. The power behind compound interest is time. And we're going to look at this. And compound interest, if you like the interest with no compounding, if you have $1,000, and this is an example of 10% each year, if you have no compounding, if you invest $1,000 and it pays 10%, at the end of each year, you're gonna get $100. And you just add that $100, not to your principal, but you just set it aside and it'll pile up $100 every year. And you can see at the end, with no compounding, you would have gotten $100 for 20 years, which is $2,000. And your total at the end would be $3,000. The initial $1,000 you invested plus the 2,000 you earned. And compound interest, that first year when you earn that $100, it's added to the bottom line. So instead of the second year, instead of earning an interest on $1,000, you'll be earning interest on $1,100. And then that 10% will be $110 you earn that second year. So it adds up and adds up and adds up. So that's how at the end of that 20-year period, at compounding, you have over $7,000. And this is an example of a couple of different investing strategies. And we have Susan here, but it's not the Susan that we know and love. She invests $5,000 annually between the ages of 25 and 35. And in total, she invests $50,000. And then we have Bill, who invests $5,000 annually between the ages of 35 and 65. And in total, he invests $150,000. And then we have Chris, who invests $5,000 annually between the ages of 25 and 65. So he invested the same amount, but he invested it for a longer period of time. And his total investment was $200,000. So at the end of the period, when everybody turns 65, you can see the difference that compound interest makes on what their final investment value is. Chris will have over $1 million, and the other two are around $500,000. So that illustrates the value of compounding. It's never too late to start saving. The longer the time frame, the greater the effect of compound interest. Reinvest all earnings and dividends. And in these examples, we have a constant interest rate of 10% over 20 years, but in reality, interest rates and rates of return are never constant. They fluctuate. They will go up and down, but in general, you look for an average return for your investment. And the stock market over the years have returned an average between 8 and 9% annual interest rate over the long term. And that's for the market in general. That doesn't apply to the different categories like the small, medium, and large cap companies. That's just the average in general. And this is another cartoon of a diversified retirement plan. 30% hopes, 30% wishes, and 40% prayers. But we don't want to be in that shape. So we're going to try to learn as much as we can about investing and take steps to be prepared. Hey, how to start investing outside of your employer's retirement plan. Now, I don't want anybody to neglect their employer's retirement plan. State of Georgia has good, sound retirement plans. They're not as good as they used to be. I retired in 2010 and have a very comfortable pension. Some of the newer employees are not going to be as fortunate as I was. I was on what we call the old pension plan, which guaranteed me 90% of my ending salary for the rest of my life. So I'm happy with that. But even at that, I started investing when I was I'm 69 now, and I started investing when I was about 45, maybe 50 years old. I've been doing it for almost over 20 years now. And it's made my retirement that much more enjoyable to be able to have money outside of my retirement plan that I can use for different things, vacations and things like that. So your employer retirement plan is very important, but still you probably, and it's like I said, it's not as good as what we had. So you're probably gonna need some outside investments to make sure you have a comfortable retirement. But don't neglect your employer's plan. Put as much into it as you can and get those free dollars that they match. Investments should be viewed on a long-term basis. This is very important. And one thing I try to point out to people when I talk to them about investing is you can't look at your portfolio as a savings account. When you invest, you should already have an emergency fund set aside. You know, most financial planners will recommend that you save at least 6 months worth of living expenses. Take care of that before you start investing, because investing is a long-term proposition. When you decide to invest, this is money that you should need for at least 5 years and preferably longer. This should be money that if the transmission goes out on the car, you have to go and get it out of your investment fund. You should, whatever you put in the investment fund, you should be willing to leave it there so it can grow at least for 5 years and preferably in the 10 to 20 year range. So try to set up your emergency fund first before you venture into investing. And these other things here are things that you will learn from following an investment program. Focus on the company's performance, and you learn how to judge that performance. It's both proven and potential, and not emotional swings in the market. You know, we have those emotional swings when the market hears some bad news, it will drop like a rock. But the thing to remember is that over the long term, the market is going up. Right now, the market is approaching an all-time high of 30,000 in the Dow Jones Index. So remember that when you think about investing. In the long run, it's always going up. And that's been the history all the way back to the beginning of the stock market. There will be downturns, but you have to have the emotional stability to weather those. I've seen in the past where the market would drop 800 points or even 1,000, 1,200 points in one day. And on paper, people have lost a lot of money, and it causes some people to panic, and they will get out of the market and have no chance of recovering that money. But like the last time it dropped 1,200 in one day, I think it made that 1,200 back in like 3 weeks. So those people who decided to sell at that point, they missed out on the recovery. So you have to be strong emotionally when you get into the stock market. Earnings are the ultimate driver of a stock price, and only consider buying when it's at a reasonable price. And by it means a company. Anyone can be a successful long-term investor as long as you follow certain principles. Invest according to a plan. Make your financial plan. What are you investing for? Are you investing for retirement, your children's college fund, your grandchildren's college fund, a second home, round the world cruise, a boat, a motorhome, whatever your goal is, you know, set that down, and preferably set it down in writing. Write your plan down. Short-term goals, down payment on a home, vacation, new car, boat. Now, I mentioned boat in long term, and that depends on how big a boat you're trying to buy. A smaller boat may be a short-term goal, but if you're looking for a bigger boat, something that you can sail out in the ocean and maybe go around the world in, you're looking for a larger amount of money. How much money do you have now? How much money will you need, and how much time before you need it? You need to have a plan and write down your goals so that you can plan toward meeting those goals. We all know about inflation, and luckily, inflation has been running pretty low in the past, I think 10 to maybe 12 years. But this is a reflection of purchasing power over time. And you can see how the value of the dollar has eroded since then to almost nothing compared to what it was by then. And we all know the stories of how back in a certain period of time, you could buy a loaf of bread for a nickel. And right now, a loaf of bread is a couple of dollars at a minimum. So we all know that inflation eats up the value, the purchasing value. What to invest in? And these are examples of different investing instruments. We did a comparison of stocks and bonds, but these are other instruments that can be invested in. And we already said what a stock was. An ETF is an exchange traded fund, and then a mutual fund is just a group of different stocks. So we'll talk a little bit about that. Individual stocks offer the potential for the greatest return, and mutual funds and exchange traded funds are good for the inexperienced investor. Once you become familiar with the concept of investing, you may want to diversify into individual stocks. And the strategy depends upon the time that you're willing to invest and the interest that you have in investing. And this is true. Some people don't want to spend the time learning about individual companies, so they will invest in mutual funds or exchange traded funds, and they can still make a good deal of money that way. Your greatest return, though, is going to be on individual stocks, and it just depends on whether you want to take the time and effort to learn that. But you can invest in mutual funds, and we're going to look later at index funds, and those will mirror the return of the market. So we'll take a look at those in a few minutes. Okay, this is about mutual funds. You, excuse me, investors pay for shares in the fund, and then the manager invests the money based on the fund's guidelines. And you have a net asset value or share price based on the value of the investment, less their cost and liabilities. And with each mutual fund, they offer a prospectus, and you have to certify that you read the prospectus before you invest in the fund. Most people don't read the prospectus. They'll just send the fund manager their money and buy their shares. But it's a good idea to read that prospectus and to understand the different types of mutual funds. And I think there's another slide later that'll go into that. Okay, some comparison between mutual funds and exchange traded funds. Mutual funds are purchased and sold at the end of the trading day. They're good for periodic saving plans, like a monthly transfer from your checking account. And the different types of mutual funds are no load, front end, and back end load. And what this means, no load funds, there's no fee to buy into that fund. Front end load means there's a fee to buy shares, and you have to pay that fee up front. And then the back end load, there's a fee, but you pay it when you get out of the fund. It's at the back end of the transaction. Exchange traded funds are purchased and sold throughout the day. They may be more tax efficient than a mutual funds. Commissions may be charged, and most of them follow the S&P index. And bottom note, otherwise they are very similar. Both are baskets of stocks, bonds, and other assets. Okay, in the mutual fund, you have what we call actively managed funds. The managers of the actively managed funds pick stocks they believe will outperform the market. And these are a couple of notes from over time that found that most fund managers trade too much, and that most mutual funds are not tax efficient. What happens with a mutual fund is that at the end of the year, the managers tend to trade companies where they had a loss in the company, or sometimes, depending on the manager, they will sell funds where they've had a big gain, and that causes tax consequences for the people who have invested in that fund. They incur a capital gains tax. So they don't look at that. They're trying to make sure that their stock performance looks good for future investors. So they don't always take tax consideration into their buy and sell decisions. And the fund holders pay for this so-called expertise, and those expense ratios can range from 0.5% to 2% or more. And transaction costs are an additional expense. Over the long term, and this is important, 85 to 90% of active managers fail to beat the S&P 500 index, and that is the index for the Standard & Poor's 500. Okay, this is passively managed fund, and most of these try to track index such as the S&P 500 or the total stock market index. Because they are passively managed, there's not much turnover, and they're more tax efficient. The expense ratio is low, and you can have two types. You can have an equal weighted index, and that's like the first four stocks that they show here, A, B, C, and D, where they're all the same size. Or you can have market cap weighted indexes, which are more common, where the companies with the highest stock market value get the most weight in the portfolio. And an example of a price weighted index is the Dow Jones average. How are we doing on time here? Okay. Try to get through so we can have time for questions. Okay, the S&P 500.
You're okay, Howard. We got a few more minutes.
Okay. S&P 500 has outperformed the market 89, well, say 90% of the large cap funds, that index. And the S&P mid cap, 90.33% of the mid cap funds. So, you know, this just shows you that if you're going to invest in a mutual fund, invest in an index fund, and because that will more than likely outperform any of the actively managed funds that you might want to buy into. Now, this is important. I had a friend who didn't want to take the time to learn investing in individual stocks. He said he'd rather pay that 1 to 1.5% fee that the mutual funds would charge and not be bothered with it. But this shows you the impact of those fees on your investing portfolio. And this is kind of a graph to show how much fee you will pay over a number of years if the ratio or the expense is either 5%, 3%, or 1.5%. This is the 5% at the top, 3, 1.5. Excuse me. Now that's just a raw picture, but I think here it shows you the dollar value of those expenses. Paying no cost, you get all of the earnings, $330,000. But at a 2% interest rate, that's going to cost you $170,000 out of your portfolio. The only thing you're going to get to keep is that $160,000 difference. So over time, those expense ratios can be very costly. And these are the different kinds of equity or index funds, total stock market, S&P 500, the international market, developed markets, emerging markets. Then you have a small cap index or a mid cap index. And then you can invest by industry sectors, These are mostly found in the index traded fund, the exchange traded funds, but you can also find mutual funds that tailor to a particular industry. And by industry, we mean things like if you want to invest in technology companies, you can find a mutual fund that concentrate on those, and even within the technology category, they can subdivide. You can invest in companies that are in the drug pharmaceuticals. They have a fund set up for them. So they have a fund set up for just about any sector of the market that you want to invest in. So the simplest plan to invest in is invest everything in a total stock market index fund. You'll be diversified domestically. That means within the US, it'll be extremely low cost. They will reinvest the earnings and you won't have to do anything. And you will likely achieve the stock market rate of return, which is going to be 8 or 9%. Almost a simple plan. Invest 50% in a total stock market index fund, 40% in a small or mid-cap index fund, and then 10% in an international index fund. And in this case, you'll be globally diversified. The other one said domestically diversified. This one, you're globally diversified. It'll still be very cost. It will reinvest your earnings and you don't do anything, and you will achieve stock market earnings. And this is an example of a equity plan. And these are Vanguard is an investment brokerage firm. And by using this, we're not recommending Vanguard. This is just an example, as my disclaimer said. But you put 50% into the total market, 25% of your money in the developed market, 5% in the emerging market, and then 20% in a REIT index fund. And a REIT is a real estate investment trust. And those companies invest in property like shopping centers and office buildings and things like that. We don't want this to be your retirement plan. Standing on the corner with a hat in your hand. All right, how to invest in stocks. If you have the time and the talent and the temperament, most important here is the time and the temperament. I am a perfect example of it. It doesn't take much talent. Anybody can do it. The instrument we use to evaluate a company is called a stock selection guide. And if you finish 6th grade and you can add, subtract, multiply, and divide, that's the extent of the math that you need to know to use that instrument. So you don't have to be a brain surgeon. You don't have to be a rocket engineer. All required is, you don't even have to be a high school graduate. It's 6th grade. Individual stocks have the potential for greater returns by you having control over what to buy, when to buy and sell, how much to pay, and then you can figure out your tax situation. And fees have gone pretty much out of the picture now because I can't think of a brokerage firm now that charges a fee to buy or sell a company. There may be some that still charge you to sell, but none that I can think of charge you to buy. And that's been within the last 3 or 4 years that has developed. You know, a association I belong to have the tools and techniques for training, but we're gonna downplay that right now. We just want you to get the idea of how you go about doing it. The basic, you learn the basics to keep performance in your favor so you can sleep at night. And it teaches you how to quickly find and evaluate the best stocks to buy, to keep emotions at bay by understanding market trends, how individual stocks may have the potential for the greatest return, and to invest in yourself about learning how to invest. This is something that you can learn, you can teach your children, you can teach your grandchildren. A good way to learn about investing is to join an investment club or form an investment club. You can learn as a group, learn how to study stocks, understand the markets, and how to manage your financial future. This is all part of the BI program, which I said we were going to kind of downplay. Now, this is something that you might be interested in. Investment clubs. In the state of Georgia, we have what we call 2 model clubs, and they meet online. We have one here in Atlanta that meets the second Saturday of the month at 12 noon. And we have one located in the Warner Robins area. It's actually in Perry, Georgia, and they meet the third Saturday at 12 noon. And if you go to that Better Investing website, and it's betterinvesting.org, and go look for the Georgia chapter, there'll be information about how you can join those meetings. And there's no obligation to join the club. You can just sit in on the meetings and ask questions and that kind of thing. You do not have to join. You can just sit in and observe, and they will go through the steps that we follow as far as investing, but that's not a mandatory. I didn't fill out that bottom part about the email because that's all on the website, and if you're interested, you can go there and find out that information. But I just want to make sure that you got the information on basic investing, and then if you want to go further with that or along learn some of the BI methods, you can follow that up. But the information that I've given you so far, you can just take that, excuse me, and pursue your own investing education. There's plenty of sites out there where you can go and learn about investing. You can open a brokerage account at any of the brokerage houses. I think Fidelity, TD Ameritrade is being bought out by Charles Schwab, but right now they're still separate. But you can go to them and you can sign up. You can open a brokerage account, and you don't even have to put money in it to open one. You just put money in it when you decide to invest. And like I said, to buy your stock, there's no fee. If you put $50 in there, you can buy $50 of whatever stock you want to invest in. But I do recommend that you try to come up with some method of evaluating companies and deciding what's a good company to buy, what's a bad company to buy. And one of the no-nos is, for the most part, don't buy a company because your cousin told you it was a hot stock and you needed to get in on it quick. That led to many falling out. So make your own decisions when you invest. I think that's pretty close. And this is one of the things I talked about in the beginning. We used up all our retirement money. First, our car retired, then our furnace retired, then our dishwasher retired. So don't put your emergency fund in the stock market. Keep that in your savings account. Okay, that's the end. So questions?
There's one here, Howard. Do you recommend we roll over our peak state reserves when retiring, or do we just leave them in?
If you have educated yourself about investing, in general, you know, a lot of investing depends on your particular situation. For me, excuse me, I've been talking so long, my voice is getting dry. But for me, that because I have learned and educated myself, I would roll it over. But if you don't know anything about investing and you haven't educated yourself, leave it in place. Because we don't want you squandering your hard saved money. So if you educate yourself and you learn about investing and you're comfortable with making your own decisions, then I would most certainly roll it over. I'd rather be in charge of my financial future than having somebody else in charge of it. As a matter of fact, if you learn about investing, most people I talk to, I recommend that they get, if it's available, roll even their company plan into a self-directed plan so that they can make decisions for themselves. But I know a lot of retirement plans don't allow for self-directed plans. So it depends on whether you want to take that time and effort to learn about investing and educate yourself as to whether you would take it out and roll it over or not. Don't want you to end up broke if you don't know what you're doing.
Right. All right. Does anybody else have any questions? You can put them in the chat. Jennifer said that this has been very helpful. Thank you, Howard, and we do appreciate it. And also, this is being recorded. Is that right, Rhonda?
Yes, it's been recorded. Yes.
Okay, so if you want to go back and look at any of the slides that he shared with us, then you'll have that. We'll send it out so you can look if you missed something or you want to look at something more. Vicki also said thank you for a great presentation.
And I have a PDF of the slides that I can share with Rhonda, and I don't know how you could make it available to the people who attended, but
that'd be great. She could email it.
Yeah. We can email it. We can also post it to our website.
Okay.
There you go.
Okay.
And Medusa said thank you. It was very helpful to her. So.
Very welcome. Very welcome.
I think investment is something we're all scared of, but it's good to learn more about it. So, all right. Does anybody else have any questions before we end? We're almost at 1. So, and again, we'll be sending this information out so you'll have it to look over. And all right. Well, I think that's it. Thank you so much, Howard, for joining us and sharing your wisdom with us. And plus, it was just good to hear from you.
Always a pleasure.
Thank you, Howard.
You're welcome very much.
Thank you so much.
All right. All right. Bye. Have a great day and a wonderful Thanksgiving.
Thank you. Same to y'all.